Oil prices are down and the markets have bounced back. The headlines say the worst is over, but the data disagrees. Here's what's actually happening. Hi, I'm Georgia Stewart, and this is the fastest 4 minutes in finance. What most people don't realize is that when you see an oil price on the news, you're looking at what traders are betting the oil will cost. That's called the futures market, or the paper market. It's like Wall Street's version of fantasy football. But there's a whole other market, the physical market. Actual barrels, actual ships, actual oil sitting in a tank somewhere. And right now, those two markets are telling completely different stories. Since mid-March, physical oil prices have been running significantly higher than futures prices. That gap is the market's way of whispering, and I'd argue yelling, that there's a real supply problem the paper market hasn't recognized yet. Why is that? Well, the Strait of Hormuz normally carries about 1/5 of the world's oil supply. Since March 1st, barely a day and a half's worth of normal flow has made it through. The last cargoes that got out before the disruption arrived at their destinations around April 13th. After that, the physical tap essentially ran dry, and the response was telling. Japanese oil refiners started buying U.S. oil. Chinese buyers drove Vancouver shipments to record highs. Indian refiners grabbed whatever Venezuelan crude they could find. Some Asian traders reportedly stopped caring about price altogether. They just needed barrels. When sophisticated traders stop negotiating on price, that's not a Wall Street story, that's a supply crisis. Now, you may have seen some alarming headlines about the death of the petrodollar. This sounds very alarming, but let's slow down for a second. The petrodollar is a system that's been around since the 70s. Basically, oil gets priced in US dollars, which keeps demand for dollars strong globally. Some recent news out of the Gulf has people wondering if that's changing. Here's my honest take. Yes, there are some real structural shifts happening. Gulf nations are investing their oil revenue differently than they used to. But a full move away from the dollar would take years to decades, not weeks. Also, the US is now a net oil exporter. That keeps dollars flowing through our economy regardless of what's happening in the Gulf. In fact, the US dollar index has actually strengthened since this conflict began. Reports of the petrodollar's death appear to be greatly exaggerated. Now, not all markets are feeling this equally. The US has a natural buffer. As a net exporter, domestic companies aren't scrambling for supply, and earnings are less dependent on overseas revenue than global peers, meaning less spillover from the shock. Europe is more exposed. Higher energy prices squeeze corporate profits, and central banks there might have to raise rates this summer to fight inflation. That's a headwind for European stocks. Japan has the least amount of cushion here. About 88% of their oil imports come from the Middle East. Plus, recent resilience has been almost entirely tech-driven. Take that out, and the picture gets a lot less comfortable. The bottom line is, this is not a moment to panic. But it's also not nothing to see here. The physical oil market is sending a signal the headlines just haven't caught up to yet. A structural shift from just-in-time supply towards strategic reserves may already be underway. Through all of it, the most important thing is to make sure you have a long-term plan that aligns with your goals so you can weather storms like this one, not just the sunny days. I'm Georgia Stewart, and this has been the fastest 4 minutes in finance.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.